Picture this. It's January 30th, 2026, and for the gold market, it's a day of absolute carnage. Trillions of dollars in value, just gone, vanished in a matter of hours. It left investors totally stunned and asking one simple question: what on earth just happened? Well, this is the story of the Great Gold Crash. So, to really get a sense of the sheer panic, just look at this number. In a single day of trading, gold plummeted $530 an ounce. That's a drop of nearly 10%. The market hadn't seen a daily loss like that in decades, and it all happened in the blink of an eye. The speed of this collapse was just terrifying. I mean, the market opened strong, over $5,400, but by lunchtime, it's in a total free fall. From there, the slide just got faster, bottoming out below 4,700, before a tiny recovery at the close. But the damage was done. The big question is, why?
And this is where the story gets really weird. This is the central mystery. You see, nothing fundamental about gold had changed. Central bank buying, demand for jewelry, industrial use, all of that was pretty much the same on January 30th as it was the day before. So if the real world hadn't changed, what did?
The answer? Well, it starts with a massive shift in how we even trade gold. To get it, you have to understand that there are really two gold markets running at the same time, and one of them has become dangerously powerful.
It all goes back to the early 2000s, with the invention of gold ETFs, exchange-traded funds. Now, this was a game changer. For the very first time, anyone, and I mean anyone, could invest in gold right from the stock market, just like buying a share of Apple or something. You could do it without ever having to see or touch a physical bar of gold. This kicked off what we call the financialization of gold.
So this created a huge split, right? On one side, you have physical gold. That's the slow, steady, long-term market. But on the other, you have this new thing, paper gold, a lightning-fast digital market built for speculators. And over time, the amount of trading in the paper market just exploded, and it started to be the thing that set the price for everybody. The key takeaway here is this: the price of gold wasn't really about gold anymore. It was about the whims of financial markets.
Okay, so you have this new high-speed market just sitting there. All it needed was the right fuel to create a massive fire. And boy, did it get some. That fuel came in the form of a highly unpredictable political climate.
In early 2025, the global markets started to feel a new level of uncertainty. Policies like aggressive trade stances and public attacks on the independence of the Federal Reserve, all of this created a deep anxiety for investors. Nobody felt like they had any idea what was going to happen next.
And what do investors do when they're terrified? They run for cover. And that cover was gold. In 2024, a pretty calm year, about $4 billion flowed into gold ETFs. But by 2025, that number had skyrocketed to $89 billion. That's not just a jump, it's a tidal wave of money, all looking for a safe place to hide in paper gold.
With all that cash flooding in, you can probably guess what happened to the price. It went into absolute overdrive. It smashed through $3,000 an ounce, then $4,000, then $5,000. Each new milestone was hit faster than the last. The market wasn't just rising anymore, it was a rocket ship.
But look, this wasn't just a bunch of nervous investors buying ETFs. Oh no, there was something way more technical and, frankly, way more dangerous happening behind the scenes. It's a financial mechanism that was turning this rally into a full-blown speculative bubble. It's called a gamma squeeze.
Okay, gamma squeeze sounds super complicated, I know. But stick with me. It's really just a vicious cycle. Think of it like a self-fulfilling prophecy on steroids, where betting on higher prices actually causes those higher prices. It creates this really dangerous feedback loop.
So here's how this crazy loop worked. Step 1, speculators start buying call options. These are basically just cheap bets that the price of gold is going to go up. Step 2, the banks selling those options, they don't want to get caught losing a ton of money if gold does go up, so they hedge their risk by buying some gold themselves. But here's the kicker. Step 3, their buying pushes the price of gold up. This makes the speculators' bets profitable. So what do? They take their winnings and buy even more options, which forces the banks to buy even more gold, and the loop just keeps feeding on itself, spiraling higher and higher and higher.
So, this wasn't just about algorithms and fancy financial terms. At its heart, this was about plain old human emotion. People saw the price rocketing up, and that fear of missing out, FOMO, it just became overwhelming. They jumped in, figuring the party would never end, which just poured more and more fuel onto the gamma squeeze.
So you've got this massive, unstable bubble, right? It's inflated by pure uncertainty and this financial trickery. Everybody knows it can't last, but nobody wants to be the first one to leave the party. All it needs is a pin. And ironically, the pin that popped this bubble wasn't bad news. It was good news.
On the morning of January 30th, the White House announces its nominee to lead the Federal Reserve, a guy named Kevin Warsh. Now, he was a former Fed governor, and the markets widely saw him as a credible, stabilizing, predictable choice, a safe pair of hands.
And that is the great irony of this whole story. The entire gold bubble, this whole panic, was built on the fear of an unpredictable Fed. The Warsh nomination suddenly took that fear right off the table. In a single instant, the main justification for gold being at $5,500 an ounce was gone. The party was officially over.
This quote just perfectly captures the chaos that happened next. That upward gamma squeeze we talked about, it slammed into reverse. Everybody who had bet on higher prices now tried to sell at the exact same moment. But in a panic, there are no buyers. The same institutions that were forced to buy gold on the way up were now forced to dump it on the way down, creating a reverse gamma squeeze that sent the price into an absolute nosedive.
So, when the dust finally settled, who were the winners and the losers? Well, the answer takes us right back to those two gold markets we talked about at the beginning. It's pretty clear when you break it down. The short-term speculators, the ones playing with options, they were completely and utterly wiped out. Long-term investors in ETFs took a big, painful hit, but it was probably temporary. And the ones who were basically untouched? The players in the physical market, central banks, individuals holding actual gold, they were insulated from all the chaos in the paper market.
Ultimately, the great gold crash of 2026 is a powerful, powerful lesson. It shows us that in our modern, financialized world, the price of something can become completely unmoored from its actual, fundamental worth. The paper market can basically create its own reality, until, one day, it can't.
Which leaves us with a pretty critical and, frankly, unsettling question. As long as this kind of market uncertainty is out there, the conditions that created this bubble are still in place. That disconnect between paper speculation and physical reality hasn't gone away. So the only real question is, what asset will be next?